According to Fidelity Investments, healthcare costs alone are running about $300,000 for the average retired couple age 65 right now. Imagine what that number will look like when you retire. And that's just healthcare. Can you protect yourself? Can you make sure rising costs in healthcare and everything else for that matter don't make you broke? Can you set up an HSA, a health savings account, as a self-employed person, an LLC, or as an S-Corp business owner? Can you become an HSA millionaire like all those folks in corporate who get an HSA via their employer? The answer is yes, yes, and yes. But there's a bit more to it than that, which is what we'll talk about today for all of you out there that are self-employed or small business owners. How you can also become an HSA millionaire and make sure rising healthcare costs don't rob you poor. What the tax implications are of having an HSA, and where you can best go about setting one up. And even if you're not self-employed or a business owner, you still won't want to miss the first half of this video. Even for those of you that are already familiar with the Diamond NestEgg coin term HSA Millionaire, we have some brand new tidbits here on how much better that HSA Millionaire number gets when you have a family, and what to do with your HSA money if you end up having too much of it. Can you use it for non-healthcare costs? Or is it a matter of generational wealth, here we come, when you pass it on to your heirs? For loyal subscribers and viewers, welcome back. We love you guys. And for those of you new to Diamond NestEgg, welcome to the #1 place to learn about money, insurance, and retirement. I'm Jennifer, first-generation American. I've spent most of my life in finance. Started working at banks like JP Morgan and Goldman Sachs at the age of 17, and graduated top of my class from NYU and Harvard Business School. And now I work on all things personal finance with business owners as well as young professionals at places like Bloomberg, WeWork, and Marsh McLennan. For those of you already familiar with our HSA Millionaire strategy and the ins and outs of a health savings account, feel free to skip ahead to how amazing that millionaire number gets when you have a family and what to do with all that money if you end up having too much. Timestamps are below this video. And for you HSA newbies or those that just want a refresher, here's a quick intro. Think of an HSA as a medical IRA, a triple tax advantage account for people with a high deductible health plan, an HDHP, that can be used to pay for qualified medical expenses both now and in the future, like in retirement. The HSA's triple tax advantage comes from the fact that 1, you're not taxed when you put money into your HSA. 2, you're not taxed on money that grows in your HSA. And 3, you're not taxed when you take money out to pay for qualified medical expenses both now and in the future. On this channel, we talk a lot about the ideal way to use your HSA. And that ideal HSA strategy, assuming you have the cash reserves to do it, is to actually not use your HSA. Instead, invest that HSA money into the market. There are no guarantees, but think long-term investing, index funds, and ETFs, which track the market and have historically trended upwards. Don't think crypto, NFTs, and other types of speculative trading. So, you invest your HSA money in the market. Let it grow tax-free. You pay for your current medical expenses, the ones that you have now, out of your income or regular savings. You save all those medical receipts, doctors, hospital visits, and medication. And you reimburse yourself years later with your HSA money that's grown over time in the market. You're probably thinking to yourself, seriously? Reimburse myself years later for medical expenses paid for today with HSA money that's grown over time in the market? That, my friends, is the HSA loophole that's becoming less and less of a secret every day as we make more of our money videos for you. You can spend now and pay yourself back later, after your HSA money has had time to compound in the market, so long as your HSA was open at the time the medical expense was incurred, and you still have the receipts. Now, the IRS might close this HSA loophole in the future, but for now, it's there. So you might as well make the most of it if you can. Just make sure you save all those medical receipts because you'll need them to get properly reimbursed in the future. Do you know how much tax-free money you'd have at the end of 20, 30, and 40 years for medical expenses if you followed our HSA strategy? We'll show you how much, and you'll be shocked. If you're single, the HSA contribution limit for 2022 is $3,650 for the year, or $304 per month. Let's assume for the ease of calculation that the IRS never increases the contribution limit ever again. So you contribute that $304 every month to your HSA. Invest it at a very reasonable annual inflation adjusted market rate of return of 7%, and don't touch this money until you retire. Start at age 25, do this for 40 years, and you'd have over $798,000 by the time you turn 65, completely tax-free to spend on healthcare costs in your later years. Start at age 35, do this for 30 years, and you'd still have over $371,000 in your HSA by the time you retire at age 65. Start at age 45, do this for 20 years, and you'd have more than $158,000. Keep in mind that from the age of 55, you get to contribute another $1,000 per year as a catch-up contribution. So, if you do this, the numbers would look even better. And if you have a family, these numbers will blow you out of the park. The HSA contribution limit for 2022 for families is $7,300 for the year, which translates into $608 per month. Do this for 40 years, and you'd have close to $1.6 million for you and your partner. Now, I know, very few people get married at age 25 these days. So the 40 years of HSA family contribution might apply to only a very small handful of you. But I'm just laying it out there for comparison's sake. So let's assume you do this for a more realistic 30 years. You and your partner would have $742,000. And even if you did this for just 20 years, you still have nearly $317,000. Not bad, huh? Guys, if you're enjoying this video so far and looking forward to becoming an HSA millionaire as you march along your financial journey with us, please give that thumbs up and subscribe. A gentle tap. I'd really appreciate it. This also tells me we're pushing out the right money-saving, wealth-building stuff for you and your loved ones. What happens though if you turn 65 and you end up having too much money in your HSA? It's a nice scenario to find yourself in. You can use the money for non-medical expenses after age 65, such as buying that Porsche you always wanted. The only thing is, if you do end up buying that Porsche at age 65 or older with your HSA money, you'll be taxed at your normal or your ordinary income tax rates. Do keep in mind that if you are under age 65 and you do buy that fancy car or boat or house, basically anything that's not a qualified medical expense, you will have to pay a 20% penalty as well as taxes on the HSA amount withdrawn. I mean, in theory, a boat, car, house, all three could be good for your health, but the IRS probably won't buy that. And what happens to your HSA money if or when you die? Well, that depends on who you name as the beneficiary on your HSA, who you designate to inherit it. If the beneficiary is your spouse and you're legally married, there are no tax implications. If the beneficiary is not your spouse, so say a child, another relative, or trust, in a nutshell, your HSA will be closed on the date of your death, the fair market value calculated, and your beneficiary will receive these funds net of any taxes that need to be paid. We'll be doing another video specifically on this topic soon because we've gotten a lot of questions about it recently. So stay tuned and hit that subscribe button to get notified. Now, let's dive into setting up an HSA if you're self-employed or own your own business. We'll start with those of you that are self-employed and then move on to LLC and S-Corp businesses. Again, timestamps are below this video. If you're self-employed, what you need to do first is to find out from your existing health insurance carrier or broker if you're on a high deductible health plan, an HDHP, that's HSA eligible. Keep in mind that not all HDHPs are HSA eligible. The IRS states very clearly that except for preventative care, a plan may not provide benefits for any year until the deductible for that year is met. This means that if you're on a more comprehensive HDHP plan, which pays for any non-preventative care before the deductible is met, including any portion of things like prescription drugs or specialist visits or an x-ray, regardless of whether that's with or without a copay or coinsurance, you might think it's a good thing, but this HDHP plan is not HSA eligible. If you need help finding an HHP that's HSA eligible and setting up your HSA, drop us a note at jennifer@diamondnestegg.com to see if we can help you sort this out. So, in addition to having an HSA eligible high deductible health plan, you'll need to meet the following 3 conditions to qualify for an HSA. 1, you can't be covered by any other plan that's not an HDHP, with certain exceptions for plans providing specific limited types of coverage. 2, you can't be enrolled in Medicare. And 3, you can't be claimed as a dependent on another person's tax return, like your spouse's tax return, for example. As a sole proprietor in 2022, you're able to deduct your HSA contribution on your personal tax return, up to the annual maximum HSA contribution limit of $3,650 as a single person, or $7,300 if you're participating as a family, with that additional catch-up contribution of $1,000 if you're 55 or older. Keep in mind that you do need to make a profit for the tax year to file the deduction, and that you can't contribute more to your HSA than your net self-employment income. Unlike most folks that work for a company who contribute to their HSA with pre-tax dollars, as a sole proprietor, you'll have to make your HSA contribution with after-tax dollars and then do a line item deduction on your personal tax return. We've shown you how you can become an HSA millionaire so that you don't have to worry about the frightening rise in healthcare costs in America. Don't let this bit of extra paperwork hold you back from having the financial future you deserve. And if you're wondering how and where to best set up your HSA, take a look at our review here on Lively HSA to see why Lively is the HSA provider of choice for our clients, as well as the #1 user-rated HSA on the market right now. Lively has comprehensive investment options, 0 fees, easy fund transfer, and digital receipt capture and tracking. So you can keep all your receipts in one place, which is very important for reimbursement for HSA withdrawal purposes. Plus, you can set up your account and enroll online or via their app in as little as 5 minutes. I've included a link to Lively below. Definitely check it out for yourself first. Now, what if you have an LLC? As a single member LLC, you're basically treated like a sole proprietor when it comes to HSAs. So everything we just walked through for the self-employed individual would apply to you as well, from having an HSA eligible high deductible health plan to contributing with after-tax dollars and then doing a line item deduction on your personal tax return. If you're an LLC with employees, an HSA can still be an option. You'd have to set up an HSA for your LLC under what is known as a cafeteria or 125 plan. This would allow your employees to make pre-tax contributions. Unfortunately, as the business owner, you won't be able to participate directly on a pre-tax basis. A cafeteria plan is an employee benefits plan administered under Section 125 of the Federal Tax Code, which is why it's also sometimes called a 125 plan. It allows your employees to pay certain expenses with pre-tax income and to choose the benefits they want, like you would in a cafeteria. That's why it's called a cafeteria plan. And funding an HSA could then be an option under the cafeteria plan. To participate in the HSA with pre-tax money from their paycheck, though, your employees must still have an HSA eligible high deductible health plan. That is non-negotiable. So what benefits do you get as an employer when you offer your employees an HSA option? Well, there are at least 3. Benefit 1, it's a great tool for attracting and retaining talent. Besides giving your employees a triple tax advantage savings account for qualified medical expenses, you're also offering them a ton of other benefits. Check out our HSA video here to see what these benefits are. Benefit 2, HSA contributions are a tax-deductible business expense if you contribute to your employees' HSAs under a cafeteria plan. This means those HSA contributions wouldn't be counted as employee income and therefore not subject to federal income tax or Social Security or Medicare taxes, commonly known as FICA tax. So basically, you're increasing your employees' total compensation and paying less in payroll taxes, all in one go. Benefit 3, you can still make after-tax contributions to your own HSA. You can still become that HSA millionaire business owner. Just remember to do that line item deduction on your personal tax return, like the self-employed individual and single LLC member. Listen, if you're thinking, gosh, love the HSA, want to start on that path to becoming an HSA millionaire, make sure my healthcare and retirement costs are covered, but I can't do this on my own, then shoot us an email at jennifer@diamondnestegg.com. Everyone's financial journey is different. Let us give yours a big, strong push. Now, what if you're an S-Corp business owner? Can you also have an HSA? The answer is also yes, but there are a few things to note as an S-Corp business owner. If you own less than 2% of the S-Corp, the IRS treats you like a normal employee. So the S-Corp can make tax-free contributions to your HSA. If you own 2% or more of the S-Corp though, the IRS treats you like you're self-employed. This means that the S-Corp cannot make tax-free contributions to your HSA, like it would be able to with other employees that own less than 2% of the S-Corp. Any contributions from the S-Corp to your HSA would be treated as taxable income to you, just like someone that's self-employed or the owner of a multi-member LLC. You cannot make pre-tax contributions to your HSA, so you'll need to contribute with after-tax dollars and then do a line item deduction on your personal tax return. And just like for the multi-member LLC, these HSA contributions that the S-Corp makes to you in this instance would then be treated as a tax-deductible compensation expense to the business. Remember that all HSA contributions must comply with current IRS regulations on employer HSA contributions. So do consult with your tax advisor first. We're not tax advisors, but if you need help with finding an HSA eligible high deductible health plan and finding the best HSA provider, give us a shout at jennifer@diamondnestegg.com. Guys, thanks for watching. Remember that thumbs up and subscribe if you like what you've seen. And see you next week with another money-saving, wealth-building video.